Okay, it's about that time. I appreciate everybody's time sitting in on this meeting today. So the topic that we're going to talk about today is specifically Medicare Part B and the decision around how to make it that is in the best interest of yourself and your family. Now, Medicare Part B is an interesting topic because it is um, effectively priced based on a lot of other things, such as Social Security, TSP, withdrawals that you make from your investments, sales of your underlying homes, um, RMDs when you hit age 73. All of these things go into the decision that is Medicare Part B. It's important to note for people who were military, who are planning on extending effectively TRICARE into retirement, those people must sign up for Medicare Part B as a requirement. For those people who are civilian, who are planning on taking FEHB into retirement, there is no such obligation. The enrollment in Medicare Part B is optional. So the question remains, should you enroll in Medicare Part B? Why does it make sense? Can it make sense for certain people? And at what pricing level does it make sense? Because Medicare Part B is a social program. Social programs are designed to help out people who don't make a lot of money and help people out less who make more money. So the way Medicare Part B is structured is, depending on how much money you make, will be how much money they're going to charge you for Medicare Part B. The starting point is about $202 per month per person, but it can balloon above $600 per month per person, depending on how much money you make. And how is the money that you make derived? Again, Social Security, TSP, RMDs, the sales of investments. So as we discuss Medicare Part B, we're going to discuss the different factors that go into it. And along this journey, we are going to talk a little bit about Social Security, and we're going to talk a little bit about how Social Security, it's been in the news a lot, how it's going to run out of, talk about what that means to you. All right. So the first thing that I always do when I'm sitting in a meeting listening to somebody speak is I ask myself, okay, who is this person and why do I care what they have to say? So my name is Greg Klingler. I'm the CEO of GIBA. I've been working with federal and state employees since 2003. I hold a certified financial planning designation. I'm a registered fiduciary. I also hold a chartered federal employee benefit consultant designation. And I hold a master's degree in financial services. But I've been in and around the federal community for a long time. I've been asked to speak on a number of topics by a lot of different channels within the federal community. And I work for GIBA. GIBA's been around since 1957. It was designed to help out federal employees just like yourself active. Now, the three words that I think make the most meaning when we talk about GIBA is expertise, experience, and motivation. All of our financial advisors have the expertise in federal. They all hold a chartered federal employee benefit consultant designation, and they must keep that up each and every year. Experience. Each one of our financial advisors has at least 10 years of experience each. And then motivation. I had the benefit of helping design what GIBA Wealth Management was today. We started doing this in 2017. And one of my focuses was to build a system that was lacking any conflict of interest. So from the top down, from the board down, we make it a point to ensure that there's nothing that stands in between our expertise and experience and the best decisions for our members. And we stand by that. All right, so I've been doing presentations in the DC area since 2013. I've been using this slide since about 2016. And I think this presentation, more than any other presentation, really encapsulates what I'm trying to say with this slide. Your financial plan, your retirement plan, is a combination of many different that need to work together in the best way possible. So think of it as a fine watch. If everything's working together well, the watch runs perfectly. If things are not taken care of, even one thing, it can throw off the whole alignment. When we talk about Medicare Part B is influenced by a lot of different things. It's influenced by taxes. It's influenced by investments, by your pension, by how you take money from your retirement. All of these things are going to influence what decision you make when it comes to Medicare Part B, and frankly, what decision you make when it comes to Social Security. When are you going to take it? So as I mentioned before, we're going to talk about Social Security, Medicare, the thrift savings plan, a little bit about your pensions, and we're going to talk about what it means to the underlying decision making as you continue on in retirement. So real quickly, you have your pension. For our people who were hired after 1984, they are under the new pension system. So the FERS pension system for those civilian people, the FSPS for those foreign service people. For those of you who were hired prior to 1984 and never switched over to the new pension system, you are under the CSRS pension system. The main difference between the two is the CSRS pension system was a standalone pension system designed to help pay for somebody's retirement by itself with no other help. FERS, the newer pension system, was designed to be a three-legged stool: Social Security, FERS, your TSP. And those are supposed to work in unison to effectively help you through retirement. And then we have Social Security. So Social Security is available for every FERS employee, and it's available for CSRS employees who put in at least 10 years of service. But we really can't talk about where it is today without giving just a little bit background history on Social Security, because it will kind of help us lead us to why Social Security is in the place it is today. All right, so in 1935, on the heels of the Great Depression, on the heels of the New Deal by FDR, they put into place one of the largest social-based programs that, frankly, the United States had ever seen and has ever seen since, and that was Social Security. And in 1935, they said, let's put in place a system that if somebody lives beyond a certain age, we will make sure that they're covered. Now, they set that age at age 65. And the reason why they set that age at 65 is because from birth to death, the average lifespan of an adult person in the United States was 65. Social Security was never designed to last and be part of somebody's normal plan. Social Security, when it was created, was designed to help people when they lived longer than they were supposed to, when they lived longer than they could work. Now, obviously, things have changed. We're living longer, and the system continues to evolve. In 1939, they realized that most households at the time were single-income households. So they brought in survivor insurance. In 1956, disability insurance. In 1965, that's when they brought in Medicare. 72, the Social Security supplement. And in 2003, Medicare Part Part D. But D really wasn't anything special until the last couple of years when they actually completely overrode it and rebuilt it without what people call the donut hole. All right, so as we progress through this presentation, I do want to kind of set some standards. Retirement is not a one point in time. Retirement is not a sprint. Odds are every single person who's retired or who will retire on day one, they will be just fine. We don't really care about day one. What we want to look at is day 10,001. Are you still going to be fine? And what changes, if any, do we need to make to get you fine on day 10,001? Because odds are for most federal employees, there will be a day 10,001. Prior to the fork in the road, the average retirement age for a FERS employee was 61 years and 3 months. When we look at the lifespan of people within the United States, now I do want to be clear, this is not the U.S. Census Bureau's lifespan. The U.S. Census Bureau is from birth to death. It takes into account stillbirths, childhood diseases, and really terrible decisions that teenagers and young adults make that unfortunately lead to their mortality. You're beyond that, probably, hopefully. So because you're beyond that, your chances of living are much, much longer. So the average man who's age 65 today has a 50% chance of living until 86, 25% chance of living until 92. Women fare a little bit better. 50% chance to live to age 88, 25% chance living until age 95. And if you're a couple, and in this case the math is for a heterosexual couple, you have a 50% chance of one person from that couple living until age 93 and a 25% chance of one person from that couple living until 97. So when we talk about retirement lasting 30, maybe even 40 years, these are not outlandish numbers. So decisions that you make now are going to be multiplied times 10, 20, 30, 40, 50 potential years. And that can really mean big dollars, maybe not necessarily for you, but maybe for your heirs when they receive it in the inheritance. All right, so Medicare Part A. So when I first learned about Medicare Part A, the person who was teaching the underlying class um, literally had a very interesting way to put it, and it stuck with me for the last 20 some odd years. Medicare Part B, A, excuse me, Medicare Part A, where you're at. Medicare Part A is going to cover the hospital where you're at. Medicare Part B is going to cover what occurs at the hospital with the actions that the doctors take. Now, how is Medicare and Social Security paid for today? The taxes that people take out, so the Medicare and Social Security taxes that are coming out of people's paychecks who are working today, covers people's benefits today. And until 2014, the amount of money coming in exceeded the amount of money going out, and we were actually able to build quite a large cushion of excess money. And that cushion was over $2.1 trillion. That's with the T, a lot of money. Since 2014, the amount of money coming out has now exceeded the amount of money going in. So in order to keep up with the promises the government made to the people who paid in, some of the money, most of the money, comes from paychecks that are taxed today, and then the rest is made up for using withdrawals from this underlying piggy bank. When you hear them talk about Social Security running out of money, this is what it means. Somewhere around 2038-ish, 2037, the piggy bank is going to run out of money. So unless things change, the amount of money that the piggy bank used to supplement the full amount will go away. And when that happens, actuaries predict that they'll be able to make good on about 80% of the money that they promised. So you will always receive a Social Security benefit. The question is how much? And the next question is, will it change? And the last question is, will that change be voluntary or will that change be involuntary? Will our legislators step up and make some hard decisions and maybe tax people more, maybe start Social Security later, maybe reduce Social Security, or maybe a combination of the three to ensure that Social Security is going to be around for a long time? The last time they did that was during the Reagan administration when they raised the full Social Security age from 65 to 67. And that effectively solidified the health of the Social Security plan by about 22 years. The sooner you make a change, the less substantial that change needs to be. Now, as you can see, we have 70 million people currently taking benefits from Social Security. That's one of the reasons why the amount of money going out exceeds the amount of money going in. 53 million are the people who were originally designed by the program. The rest of the 17 million are the extras that were added on over the years. How do you qualify for benefits? Well, let's quickly just talk about Medicare. If you're 65 and older and you paid in for 10 years, you're eligible for Medicare Part B. If you're under 65 with a disability and you paid in to Medicare for 24 months, you're eligible for Medicare Part B. Medicare Part B starts off at $202 per month per person, and it may go up to over $600 depending on your income. Because again, this is a social program. Both Social Security and Medicare are designed to help out people who make less money and designed to help out people who make more money less. So how do you qualify for benefits? We talked about credits. You have to work 10 years. This is how it works. It used to be quarters, and people always talked about their quarters. Now it's credits. And the difference is you can make the money in one quarter and earn up to 4 credits per year. As long as you make $1,890, you are eligible for a credit. If you earned times 4 in that, even in a given month, that would give you up to 4 credits a year, and you would have already earned all of your credits for that year. You get 40 credits, or effectively 10 years of work. You're qualified for Social Security and Medicare Part A and B. All right, so now let's quickly talk about Social Security and how much of it's taxed. Because again, this is a social program. It's designed to help out people who make less money. So what they said is if you make it below a certain threshold, 0% of your Social Security is taxed. And the way they do it is they take the adjusted gross income plus non-taxable interest, like let's say muni funds or muni bonds, which ordinarily would not be taxed. They are calculated into this equation, and then they take half of your Social Security. They add it all together. And as you can see from the slide, if you make less than $25,000 per year, no part of Social Security is taxed. If you make between 25 and 34,000 per year, 50% of your Social Security becomes taxable. And if you make more than that, 85% of your Social Security becomes taxable. And you can see the numbers for the married couple filing jointly as well. So what is the right age to claim Social Security? Now, Social Security, in a lot of ways, it's a break-even point. If you take it earlier, you get less for a longer period of time. If you take it later, you get more for a shorter period of time. If you live longer, it's best to bet on yourself and wait to take Social Security. Now, it does become a little bit more complex when we factor in spouses, especially factor in spouses where one person is expected to substantially outlive the other person due to age or health primarily. Because when one person of a couple passes away, the remaining person only gets one Social Security benefit, but they get the bigger one. So planning for that can be very important. All right, so let's talk about that full retirement age. It used to be 65. Then during the Reagan administration in the early 80s, they changed it very slowly from age 65 to people who were born after 1960 to age 67. If you take it at your full retirement age, you get what's called the full PIA, or full primary insurance amount. If you wait, you get more than that. If you take it earlier, you get less. And as I said, it is a break-even point. So assuming that your full retirement age is age 66, so you're born in 1954, you'll get 100% at age 66. If you take it as early as you can, you'll get 75% of that at age 62. And if every year that you wait, you'll get an extra 8%, which will max out at age 70 for a total of 132%. Now let's talk about earning money while trying to take Social Security. So effectively, for those people on this call, most of the time, it does not make sense to try taking Social Security if you're below your full retirement age and you're working. Because for every $2 that you make over $24,000, they're going to reduce your Social Security benefit by $1. In the year that you reach your full retirement age, and this does go by month, so for every $3 you make more than $5,430 during that month, they will reduce your Social Security benefit by $1. Once you reach your full retirement age, so for many people on this call, it's going to be 66 or 67, you can work and collect your full Social Security benefit, because after your full retirement age, there is no such limitation. So as we look at taking Social Security, we ask ourselves, how's your health? Because health lets us derive longevity, and longevity lets us derive how long are you going to get paid. And it helps us quantify how much money in total we can get if we wait. Are you still working? Because we don't want to take Social Security while you're still working. Do you come from a long-lived family? Again, longevity. Are you eligible for benefits on someone else's record? Because you can be eligible for benefits on your record and your earnings. You can be eligible for benefits on your spouse's record and their earnings. And in fact, if you were married for at least 10 years, you can be eligible for your ex-spouse's record on earnings. Do you need income? If your retirement plan requires you to get income, We can talk about the best numbers and the best ratios and everything else, but at the end of the day, if you need money, you need money. And then will other family members qualify for benefits? If you're in many cases part of a second marriage where you have had children later in life, a much younger spouse, these are times where you could take Social Security and receive benefits for that spouse who's caring for children who are under the age of 16. And you can receive benefits, frankly, for your children who are under the age of 16. So there are ways to stack benefits if you fall into that general category. And then last but not least, have you thought about your spouse's needs? So I'm just going to tell you a quick personal story. So my father has a lot of pensions associated with him, and he did finish his career, started his career in the military, and ultimately finished his career um, as a civilian federal employee. A lot of pensions tied to his name, very few pensions to my mother's name. My mother is younger, she's female, and she ultimately has the potential to live a lot longer because she's much healthier than my father. Unfortunately for my father, he's not really eligible for life insurance anymore. So how do we protect my mother from the loss of all those pensions if something were to happen to my father? And the only answer that was really on the table as it stood right now was he should wait until age 70 to take his Social Security. That provides effectively protection for my mother in case something happens to him. It's not life insurance, it's not investments, but it is a way to protect my mother, who probably will outlive my father by a large number of years. All right, so this is the break-even point in just kind of a different way. Now, for those people who are single, it's actually a pretty simple calculation. If you're going to live past the mid-80s, it generally is mathematically good to wait and take your Social Security as late as possible. If you have health issues or family longevity issues, or you think that's not going to be the case, taking it sooner generally makes a lot of sense. As I said before, once we add a spouse to the equation, it becomes a little bit more complex. All right. So as a reminder, you can take Social Security benefits based on your earnings, and you get 100% at your full retirement age. You can take it based on your spouse's earnings, but you only get 50% spouse's benefits. Keep in mind, in order to get your spousal benefits, your spouse must file for their benefits before you can. And as a survivor, you're eligible for one Social Security benefit, but the larger one, either yours or your spouse's. So, rules for spousal benefits. The primary worker must have filed for benefits first, as I just mentioned. The spouse must be at least 62 years of age. If they wait till the full retirement age, they're going to get a larger percentage. There is no benefit for a spouse who wants to take a spouse benefit after the full retirement age. You don't get that 8% like the primary worker does. And as I said again, couples of different ages or different health categories may have many different strategies to consider. And this is just a quick example of what happens when one person typically takes it longer. So we have John and we have Abigail. John's full retirement amount was $2,000. Abigail's $1,600. Abigail is in much better health than John. The expectation is she's going to live a lot longer than John. So the decision was made, John should wait because he was slightly more of the breadwinner than Abigail. Abigail, on the other hand, should take hers as early as possible because at some point hers is going to disappear anyway because she's going to lean on John's. So at age 70, John's grows to $2,640. Abigail stays at $1,200. And again, I'm excluding cost of living increase adjustments just for simplicity's sake. While both of them are working, they are both eligible for $3,840 in Social Security benefits. And then if John passes, Abigail will lose the lower of the two and still be able to maintain the $2,640 for the rest of her life, and she will continue to get those cost of living increase adjustments on top of that. This was a way, just like my father, for John to protect Abigail without insurance or without a survivor benefit on their pension, but it's a way. All right. And the point of this slide, this is a software that we've used in the past, calculating the best time to take Social Security versus the earliest time. And as you can see from the graph on the left side, the difference between the best time and the earliest time for somebody who's going to live until age 85 and age 90 is somewhere in the neighborhood of $240,000. As I said earlier in this presentation, these small decisions that we make today turn into big dollars because we're talking about these decisions paying out over the course of 20, 30, 35 years. And that can mean a big difference at the end of the life. It can mean a big difference when you're trying to make sure you have money, or if you're looking to maximize the money that you leave to your heirs. All right, so let's quickly talk about the thrift savings plan. There is a guy, you might have heard of him, Warren Buffett, pretty savvy investor. He has a lot of quotes, but this is one of my favorite quotes. To invest successfully over a lifetime does not require a stratospheric IQ, unusual business insights, or inside information. What's needed is a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. What does that mean? In its most simple way to explain it is make sure your portfolio is diversified. And that the diversification should be a combination of your investment time horizon, how long you have to invest, and different dollars can be invested for different times. Just to be clear, we generally talk it through kind of as a bucket approach. The first 5 years should be cash. You need that money soon. It cannot be associated with market ups and downs. The next 5 years, the market is generally pretty secure during that 5-year period. You can take a little bit of risk. Then after 10 years, the market's never gone down. So any money that you have earmarked 10 years on can be very aggressively invested. So understanding your allocation and having an allocation that you're comfortable with. The worst thing anybody can do is when the market crashes to pull out at the bottom. That's effectively buying high and selling low. That's what we don't want to do. So having a framework in place that you're comfortable with, that makes sense, and when the market does correct, because healthy markets correct, that's the portfolio that you want. And how a portfolio is measured changes. This is just an example. In June 2008, the equity companies represented about 16.6% of the US stock market. If the Strait of Hormuz has closed in June of 2008, the effect on the market would be vastly different than what it was today, whereas the energy markets only represent 2.8% of the US stock market. And the market tends to move in cycles. And a healthy market does correct, and there's nothing wrong with that. But a market downturn tends to be followed by a recession, and then followed by a very healthy move up in the market. And that's what we tend to see over and over and over again. And it's one of my jobs as a financial advisor is to remind people of that. When it goes down, it's typically going to go up. And you don't want to get out and miss the up. As you can see right here, this is the tale of two different people, effectively three people. The market crashed right during the Great Recession, end of 2009. One person didn't change anything, kept their money invested, and as of 2023, they had $672,000. The second person took their money out, waited a year. Once they got comfortable, they put their money back in. That person ended up with $408,000, or almost a $265,000 difference for 1 year. Nothing else changed, just 1 year of investing. And the last person, they took their money out and never put their money back in. And they're sitting at $135,000. As Warren Buffett said, he's a pretty smart guy. It cannot be influenced by emotion. The top line was the person who was not influenced by emotion. The middle one was somebody who was trying not to be, but was. The bottom line was the person who was absolutely influenced by emotion, and it stuck. And you can see in a dollars and cents difference what effect it has on different people. The goal of everybody on this call is you want a portfolio where you can be the top person, the person who doesn't change anything, who lets it ride. Because the longer amount of time you have, the more the periods of loss level out. And eventually you get only periods of gain. As you can see over 1 year, the market loses money. A healthy market does. About for every 2.5 up years, we see a down year. That's normal. But then we look at it over 5 years, the middle graph, and all of a sudden, time has smoothed out a lot of those down bars. And over 5 years, the probability of you losing money is only 13%. And then we look at 10 years and 15 years. By the way, this graph is going to look pretty identical, this bottom graph, for 10 and 15 years. The market doesn't lose money. 10 years has given the market the ability to smooth out the ups and the downs, and now we're looking at ups. So any money that you have earmarked for 10 years or more out, you can take some risks on that. And the probability of long-term gains continues even when there's crises. Those of you probably remember the crash of 1987. It was bad for a while, but then it came back. The U.S. savings and loans in 1989, not too long after that, the loan crisis. It was bad, and then it came back. The dot-com crash in 2000, it was bad, and it came back. And this, incidentally, is one of the worst 10-year periods we've ever seen. And then it came back. September 11th, it was bad, and then it came back. You get what I'm trying to say here, and what Warren Buffett was trying to say. Have that portfolio and let it ride. And I'll specifically talk about your TSP. One of the great things about the TSP, especially since the TSP Modernization Act of 2017 implemented in 2018, is it's inexpensive. And now, because of that act, you can choose a lot of different distribution models as well. That there's a lot of flexibility into how you got your money. Before 2000, it was very difficult to get your money and very difficult to run a retirement off of how you get your money. Today, it's much different and much easier. So your options. Traditionally, the iFund is considered the most risky option because it takes into account foreign currencies, exchange rates, foreign politics, because you're investing in different markets, not including China and not including Hong Kong. Next, we have the S Fund, which is pretty much mid-size and small companies, because mid-size and small companies are of higher risk because they have less access to capital. And they're more sensitive to oil costs and exchange rates and things like that. The S Fund is generally considered to be more risky. And then we have the C Fund, which is the S&P 500, the 500 biggest companies in the domestic United States. Then we have the L Funds, which are a diversified portfolio of all 5 of the different TSP options, the I, S, C, F, and G. Then we have the F Fund and the G Fund, which are both effectively bond-related funds, which have a much lower return, but traditionally have a lower level of risk. At the end of the day, long-term, generally, if you take on more risk, you should expect more reward. If you take on less risk, you should expect less reward. Now, in the short term, that can flip on its head a little bit, but in the long term, those words tend to stick. And here are your options, as I mentioned before: G, F, C, S, I, and L. The G Fund. The return is based on the 10-year Treasury bond yield. It is considered the safest investment, but you can very well lose money to inflation. The F Fund, it has been a dog over the last 10 years, and it has been a dog because interest rates were low. The way the F Fund really does well is if interest rates are reduced. Bond prices tend to go up when interest rates go down. They have this reverse causation. If interest rates go up, bond prices go down. We're currently sitting at a 7% mortgage rates. They're talking about cutting rates a couple of times next year. 3 years ago, I would never have recommended the F fund. Today, the F fund has become much more interesting of an investment for people who are looking at fixed income within the TSP. The C fund, over the last 10 years, this has been the winner. The Magnificent Seven has taken off. In fact, the Magnificent Seven represents about 40% of the S&P 500 at this point. So what used to be a very diversified investment, this index that is the S&P 500, it's a lot more centralized than it used to be. So be aware of that because there's risk in less diversification. But over the last 10 years, 15% per year, it has done very, very well. The S fund has been the second best fund. Now, since 1923, the S fund, or small companies, tend to outperform large companies by about 2.3% per year. Over the last 10 years, that has not happened, but over the last 100 years, that absolutely has happened. So just be aware as you're looking to diversify your portfolio. S fund tend to have more risk, but over the long term tends to have more reward. And this year, the S fund's up higher than the S&P 500. Then we have the I fund. The I fund has really struggled over the last 10 years relative to its counterparts, considering it's supposed to be the most aggressive fund. But that doesn't mean it's a bad fund. Now, it has done a little bit worse than its peers because it cannot invest in China and Hong Kong. And over the last 15 years, China has done pretty well. But that doesn't change the fact that if we look at the world market, about 60% of the world market is not the United States. And if you want to be properly diversified, you really should invest in the world market, because diversification eliminates what we call systematic risk. And we want to eliminate as much systematic risk as we can, because that ultimately that'll mean long-term better returns for the same amount of risk. And then we have the L funds. L funds are designed with those underlying funds that we talked about within the TSP, and it changes in allocation as you get closer to your end date. The end date is designed to be your retirement date. Now, I do want to say that all L funds, or not all target date funds, are not all built differently. If you were to look at the L funds offered within the TSP, and then let's say the equivalent 2035 target fund at Vanguard or Fidelity, you would see that the L funds are actually tailored to be much less risky than those Vanguard and Fidelity counterparts. BlackRock, the company who runs it, has just chosen to take that line when it comes to these investments. So just be aware of that. A Vanguard 2035 fund is going to be more aggressive than the 2035 L fund. Retirement and withdrawals, as I mentioned, the TSP Modernization Act greatly increased the flexibility of taking your money, which is great. As long as you take at least $1,000, during retirement, you can take money every 30 days. You can take systematic withdrawals, and you can change your systematic withdrawals every 30 days. And you can ultimately, and you've always been able to transition money from a TSP to an IRA, or from the Roth TSP to a Roth IRA. All right, one item that I do want to mention, because I have found that this can go badly, and I have also found that a lot of estate planners may not be aware of this fact. So I think it is important to talk about it. All right, so if you have a TSP and you pass away, the money can go to your heirs, no problem. There's no issues whatsoever with that. It can go to your spouse, no problem. Understand that there is definitely a difference from a government view standpoint in heirs versus spouse. If it goes to a spouse, the spouse can keep it in what's called a beneficiary participant account. It's just a TSP, but for the heirs, the spouse. If the spouse continues to keep it and passes away with the beneficiary participant account, or the BPA, all the money that's left in it will go to their heirs in one lump sum. Not stretched out over years, one lump sum. So if that number is $1 million, the beneficiaries will receive $1 million of taxable income. The Secure Act 2.0 ultimately allowed money to be passed to heirs over a 10-year period in smaller chunks, creating a lower tax burden because you're in a lower tax bracket. Money rolling into a BPA and then money rolling out of the BPA upon death eliminates that 10 years. You don't have that option anymore. So once you get to the point where the money is going to the beneficiary account inside the TSP, it is wise to transition that beneficiary account into an IRA to protect your heirs of a substantial taxable event. I hope that makes sense. If you are the primary investment person in the household and you don't think your spouse will be of presence of mind to do that, it may make sense to transition your TSP to an IRA earlier. The answer is unique for every couple, but that's something that you definitely want to be aware of. Okay, so required minimum distributions. The Secure Act 2.0 did do one nice thing for required minimum distributions. Now, required minimum distributions are the government saying you have to take your money out of your IRA or your TSP. You've deferred paying taxes long enough. We want to get our cut, so we're going to make sure that you take the money out based on a calculation, and that calculation is designed for you not to run out of money. The Secure Act 2.0 said, well, it was age 70, but because people are living longer, we're going to bump that up to age 73, and it will hit age 75 at some point in the future. But once you hit that, you have to start taking money out. And once you start taking money out, you have to pay taxes. And this is where a lot of people are surprised when it comes to Medicare Part B, because RMDs have an effect on earned income. Earned income is how Medicare derives how much money you owe, how much money you have to pay for Medicare Part B. So a lot of people make the decision to go into Medicare Part B, and they know how much they're going to pay, and then their RMDs happen. And there are, by the way, 190,000 TSP millionaires right now floating around. Depending on market, it's right around 190,000 people. $1 million TSP is going to be a minimum withdrawal starting off with well over $30,000. And that $30,000 can change and bump you into a completely different category and a completely different cost structure, making Medicare Part B and the quantitative effects of it much, much different. All right, so let's just quickly talk about how this works. So we have a federal employee, they're single, 73 years of age. They have a first pension of $46,000. They waited till take their Social Security till age 70. It's about $44,000. They have a TSP balance that's large, but not outlandish in any way, stretch or shape or form, of $750,000. Their RMD as calculated, the first divisor is 26.5. So you take your December 31st balance, you divide it by the divisor, which, by the way, every year you get older, that divisor gets bigger. And that leads to a required minimum distribution of $28,000. So we take what ends up being their original modified adjusted gross income of $83,000, and we just add $28,000 to that total. That pushes you up in a tax bracket to 24%. It also pushes you up a tier in the cost of your Medicare Part B. You go from $202 to $284, or an effective increase of $974 per year. So what you may have thought was a good deal for the cost of Medicare Part B, that just changed. And again, consider the average person lives to 86 if they're male? So that's 13 years of this amount that you were not expecting to pay. So as we look at Medicare Part B and the decision associated with Medicare Part B, just understand the effect of required minimum distributions. And here's the tiers. As you can see, the lowest tier is $202. The middle tier, which is pretty small in general, adds $81 to the cost. The next tier adds a full $202 for a total of $404 per person per month. And that's when it really starts getting expensive. And we do see a lot of federal employees who do fall into that category. Now, the reality, the bottom tier is quite expensive, but we do not see a lot of federal employees falling into that, just for your reference. All right, so we've talked about the cost. Now, what's the value to Medicare Part B? As I said, if you're a military person, you have to. There's no choice. If you're a civilian trying to take FEHB into retirement, there is no requirement to purchase Medicare Part B. So now the decision is, should I? And what do I get? So let's talk about Blue Cross Standard. It's the most popular plan by a large margin. Most people have it. If you sign up for it, Medicare Part B, you're going to get an $800 Medicare premium reimbursement. $800 off your premium. You get lower prescription copays, eliminate deductibles, eliminate copays, eliminate hospital visit admissions, co-insurance. Effectively, what it does is it eliminates the worst case scenario, the out-of-pocket maximum. The out-of-pocket maximum for the Blue Cross Standard Plan is $6,000. So for an individual, the most that individual can pay is $6,000. So when we talk about the best case scenario for Medicare Part B is to save you $6,000 in a given year, that would be an accurate statement. So is it worth it? For the example that we talked about 2 slides ago, the cost of Medicare Part B is $3,409. You get $800 discount from your FEHB plan under FEP Blue Standard. And worst case scenario, if you max out everything, you'll save an additional $6,000 or the annual maximum for a total savings of $6,800. So the question I have to ask you, and you have to ask yourself, is it worth me paying $3,400 to save worst case scenario $6,800 in this scenario, in this example? The answer for most well-off federal employees is generally no, because most well-off federal employees are paying this amount or more in Medicare Part B premiums. Now, if your health and you expect your health to have to max out your annual maximum each and every year, then paying for Medicare Part B absolutely makes sense. But if you're not coming close to your annual maximum in 2 out of 3 years, it generally does not make sense to take Medicare Part B. Each and everybody's different. If you have questions, you want to help you decide, we're happy to do so. How can Giba help you? As I said before, we are certified financial planners. We have experience, we have motivation, and we are here to help. That's exactly what we were put on this earth to do back in 1957. And that's what our board and our staff takes very, very seriously. These are all the items that we do. And if you don't have a trusted financial advisor who is experienced with federal benefits and how they all work together, please reach out to us, give us a call, schedule an appointment, virtual, in person. We are happy to help in any way we can. And like I said before, we take that very, very seriously. All right, so I'm going to give you just a moment to write down the number if you need it, write down the email if you need it. You will receive an email after this is over, and you will receive a survey after this is over. Please fill it out. We do take your suggestions and your thoughts very, very seriously. All right, so let's look at some of these messages. All right, so somebody did mention there was a rebate for basic but not standard. Now, under my research, I believe it was both, but we're going to write that down, Bernie, and we're going to make sure that we get you the right information. But with that being said, and when we talk about the calculations, the point I'm trying to make is you want to take into account what it gives you and take into account what it costs and understand the difference before you make a decision. You want to make sure that your decision is um, as educated as possible. Right. Here we go. So I'm pulling up chats now. If you have any questions, please feel free to put them in the chat. I'm happy to answer any questions for the next couple of minutes. And again, if you have a personal question, please reach out to us directly, and we are definitely happy to help out. All right. Where do you find an equivalent of a plan brochure for Medicare Part B to figure out what items are covered? So, I mean, the reality of it is, if you have the FEP Blue or the FEHB plan, any FEHB plan, Medicare Part B is the primary payer, and then the FEHB plan comes in and pays for the rest. So the reality of it is, what's covered under your FEHB plan is pretty much what you're going to want to focus on. But then you're going to also want to focus on, if they give you benefits for buying Medicare Part B, what are they? You know, Blue Cross was a great example because Blue Cross wants people to sign up for Medicare Part B, and they've been very clear about that. And that's why they give you all these benefits, like the premium rebate. Again, so I think somebody mentioned, Bernie mentioned it was in the basic plan, and we'll double check on that. But it also gives you the reductions in copays and things like that. So focus on the FEHB plan and what the FEHB plan will give you if you sign up for Medicare Part B. That's really the key there. All right. Is it possible for the administration to steal money from the TSP? They have frequently demonstrated their intent to break laws. Um, so technically, legislatively speaking, in a shutdown, the government is able to, if they have to pull money from the G fund. I don't believe it has ever happened. I know it was talked about a lot during the last really long shutdown, not last year, but the time before. Um, I'm not too concerned about that. I don't think it's going to happen, but technically that is a possibility. How does oop, how does 100% VA coverage impact Medicare decisions? Um, you know, having 100% VA coverage is provided that you have a VA hospital near you that you're going to. Um, in my opinion, that would probably end the conversation right there. There probably would be really no reason for you to go with a Medicare Part B if you have 100% VA coverage. One item just to add to the VA conversation. So there, if you run out of money, there are two concepts that, or two, I guess, backdrops that protect people from with health issues. There's Medicaid, and if you go to Medicaid, they're gonna take all of your money. And even if you gave away the money 2 or 3, 4 years ago, they're gonna go back and get that money. So the idea of giving away your money going to Medicaid doesn't really work. With the VA, that actually becomes a much stronger possibility. You can give away your money and there's no clawback like you see with the Medicaid situation. So VA does give you a lot of options and more flexibility with kind of releasing your money to your heirs early and then falling into the VA category, long-term care and things like that as well. All right. It looks like I have answered all of your up here. We got one more. Is the only time we can sign up for Medicare Part B after you stop employment or age 65? That's actually a great question. I did not mention that. So short answer is yes. Longer answer is you can sign up for it later. But what they do is they will, every year that you are late, you sign up after when you were supposed to, they're going to increase your Medicare cost by 10% forever. So if you're going to sign up, sign up. You can always cancel, but signing up late definitely comes with a penalty, and a penalty that lasts, forever until you pass away. Um, just to leave you with one additional item, and again, please take the survey if you're signing off. Um, Most of the time when we work with somebody and we're able to do a financial plan because they have a substantial pension, a substantial TSP, Social Security, maybe a home that's probably close to paid off, if not paid off, and they're in good health. In almost every case, mathematically, Medicare doesn't make a lot of sense. If they have substantial health or not a lot of assets, that's when Medicare Part B really starts making a lot of sense as just a general rule. Now, we're happy to get a lot more granular when it comes to that decision-making process, but as a general rule, that's typically what we see. Any advice on Medicare? Oh, we got some more coming in. All right. Any advice on Medicare Advantage plans that some FEHB providers offer? Those are options, and we've seen those options. I'll be honest with you. The FedVIP plans are excellent. The coverage, especially for prescription drugs, are excellent. They're subsidized right in the neighborhood of 73% on the average, which means the government pays 73% of those premiums. I tend to look at those first, but there's a couple of good Medicare Advantage plans out there. That is correct. Yes. Joe R mentioned the Medicare 10% penalty is on the basic amount, the 202, not the full Medicare amount. That answer is correct. So expected to go about $20 each and every year you wait. All right. How much does it cost to work with Geeb as a financial advisor? That's kind of a unique situation that we were able to set up. So we believe in a couple of things. We believe in doing a financial plan for people, and it's free of charge and it's no obligation because we don't believe in making recommendations until we know you. So when we start a relationship, we do ask that you trust us and allow us to go through a financial plan that's strong enough and detailed enough so we can give you good advice. That's free. That's no obligation. If you like our recommendations, then you start working with us. We have a number of ways that we work with people. As a nonprofit, we work a little bit differently than a lot of different carriers out there. We try to keep our fees under assets under management. We try to keep it close to half of what the market average is. And we still have to keep the lights on, but as a nonprofit, we can do things just a little bit better. But the financial plan, the recommendations, all that stuff comes free of charge, no obligation. All right. We saw that. What are the payment fee percentages scale? So we will send you the slides. I think it was the fourth to last slide. That was the actual payment fee percentage, or the scale based on how much money you made. That will be in there, and I think it's the fourth to last slide. Or you can just look it up. The weird thing about Medicare Part B is they look back 2 years. So if you see stuff like 2024, that's the most current one when it comes to income. When someone makes an appointment, do you look at the full scope of retirement fund? We prefer to do it that way, yes. We prefer to do as holistic of a financial plan as we can. We understand that some people are a little particular about keeping certain things to the side, but the more information that we're given, the better the recommendations we can make. So we definitely like to take into account everything, and specifically what you're invested in within your accounts as well. Does financial planning include tax planning in addition to investing? So as a part of a financial plan, we definitely look at tax strategies as it comes with distribution options. So when to take money from where, the TSP, doing a, let's say, a Roth conversion. These are all things that we definitely discussed. Now, will we do actual taxes? No, we're not accountants. We don't do taxes. But are taxes part of the discussion of your distribution plan? Absolutely. Okay. Bernie, you mentioned the Blue Cross Blue Shield Basic and Standard. I'm going to get you an answer on that just to make sure that you're taken care of. Yep. And then somebody mentioned estate planning. So yes, estate planning is part of the process we go through. Again, full financial plan is going to account for all those things. Now, typically, what we see is people who are entering retirement. We're really only focused on them in their retirement. Once that person gets comfortable in retirement and knows they're going to have money left over because their pension is big enough, their TSP is big enough, they've gotten more comfortable in where they're at from an expenditure standpoint. Most retirements kind of go through three different stages, right? You have the go where, hey, I retired, I'm going to travel, I'm going to have some fun. And then you have the slow go where, well, I'm not going to travel anymore, but I'm in good health. It's not really costing me any money, but I'm spending less. And then you have the no go, which is that's when we start seeing expenditures creep back up again as people need help with different things, whether it be help when you used to work on your car, but now you can't, or somebody mowing your lawn, or long-term care and the cost associated with that. Um, but when we look at a full financial plan, when it comes to the point where we should start looking at the estate plan, the legacy, leaving money to your heirs in the most tax efficient way possible, yes, we do start that conversation. It just depends for each individual person. Um, the timing of that tends to vary. All right. Do you have seasoned professionals or newbies to give us advice? So all of our financial advisors have over 10 years of experience. They hold a chartered federal employee benefit consultant designation, and they keep it up every single year. So it means they're experts, or they've proven to be, to an extent, experts on federal employee benefits. So they do have expertise and they do have experience. The payment fee, they asked what the payment fee percentage scale is. So if you're referring to how much we charge for assets under management, we start at 60 basis points for the smallest accounts and we go down from there. As I said before, we try to keep it about half of the market, what the market on the average charges. And we do our best to stay within that number. Um, when someone makes, yep. Can you help with funding your own long-term care plan, self-funding? Oh, absolutely. That's so from a financial planning standpoint, the discussion on long-term care has to happen. Because long-term care has a high probability of happening, it has a high duration when it does happen, and it's very expensive. In the Washington, D.C. area, the cost of a semi-private nursing home room is about $135,000 a year. So it's a risk, and it's a big risk. And big risks are things that we care about within financial planning. Now, how you meet that risk, that's something that we do help with the planning. Some people who have pensions and assets and things like that absolutely can self-fund against those risks. And that's perfectly fine. Most federal employees can self-fund at the very least a portion of those risks. Anything that you can't self-fund, then the decision has to be made, do we look at insurance? Do we wrap up that risk and we pass it to an insurance company for a cost? Everybody's different, but self-insurance is absolutely part of the discussion. The goal is to figure out the right solution for you. And when we do a financial plan, it's not about long-term care insurance. It's about a solution to the high cost of long-term care, whatever that solution may be. Hopefully that makes sense. That was kind of a bit off topic, but I think it's very helpful for this conversation. All right, so time for one last question. So it looks like no more questions. I'll just leave you with one last thought as people are entering retirement. Where your retirement matters. Where you retire matters. It matters for two primary reasons. The first one, state taxes. And is Social Security taxed within your state? The second one is long-term care. The difference in cost between Connecticut and Texas is $100,000 a year for the median cost of long-term care. Connecticut's one of the more expensive areas. Texas is the cheapest. Hawaii is a difference of about $95,000 as well. So where you retirement matters. Now, for people who want to live in Hawaii or want to live in Connecticut, that's perfectly fine. You just have to understand the cost that's going to come along with it. And we help kind of guide you in that way. You can do this. It's just going to cost you X dollars more. And that's fine if you can afford it. All right. This is the last question. You will be receiving an email. So if anybody has any additional questions after this, please just send them our way. We'll make sure all of your questions get answered. To avoid the immediate impact of taxes for heirs, is it advised to move money from a TSP to an IRA earlier? Or should one try to draw down the TSP before tapping other IRA investments? The reality of it is, for assuming that you're not part of you don't have money in a BPA account right now, there really isn't a lot of difference from an heir standpoint, whether your money's in the TSP or the IRA. The reason why you would, if you chose to move money from a TSP to an IRA while you're young, and it's not a BPA account, would be either I want to control the process earlier, I want access to more investments, I want access to somebody to professionally manage my account, thinking I can do better. Those would be the primary reasons why you'd move money from a TSP to an IRA earlier. The other question is, to avoid taxes to your heirs, do we start doing IRA to Roth IRA conversions? There is a window in time during your retirement where generally it's going to make sense. And that window in time is when you're not pulling out major money from your TSP, when you're not of required minimum distribution age, and you're not required to take Medicare Part B yet. You're under the age of 65, or you don't have Medicare Part B. And we want to be very careful in choosing when we do IRA to Roth IRA conversions to avoid bumping you up in tax brackets when we don't want you to be. We want to focus on doing it when you have the lowest option, the lowest tax brackets. And you're not going to be affected by income that's created by it, like Medicare Part B that would go up if your income goes up. All right, so that is the last question. I really appreciate everybody's time and staying with me at this point. I know I'm 10 minutes over. You will be receiving an email. You will see the survey. Please let us know how we can help. We take that very seriously, as I said before. I know it's been a lot for federal employees over the last couple of years, and we do our best to make it as streamlined as possible on our end. All right, thank you very much. Have a great day.